Hello, everyone. Welcome. Welcome to the Everything Money YouTube live stream. We are here today on Tuesday. We are fired up. We're in Ohio, our Akron, Ohio podcast studio, and we're ready to rock and roll. Paul, we prefaced today's live stream. We're very excited. First and foremost, to get your comments, your questions, of course, your likes. But Paul, you wanted to also describe the $100,000 car giveaway. Now, as a viewer, I would think this is total bullshit. But if you're new to the channel, this is real. And Paul, will you please describe it while I pull up the comments on YouTube? Go ahead.
So I'm very active on LinkedIn, and I'm always looking for real estate deals. I recently started offering a $100,000 car to anyone who brings me a real estate deal that qualifies that I end up purchasing. What does qualify mean? Now, for a lot of people who are watching, you know people, you have family members, somebody out there is rich and has a big property. I want at least a $5 million property somewhere in the US. This is not limited to one deal. If I got 10 deals tomorrow, 10 people get a $100,000 sports car. My thank you to you will be a $100,000 sports car. If you bring me a deal that I end up closing on, that qualifies, at least a $5 million deal. I don't care where it is. I prefer Midwestern states because the value is better. But I've seen deals in LA. I've seen deals in Arizona. I've seen deals in Florida. But the point is, $100,000, I want deals. I'm willing to buy 1,000 units a year. So this is it. This is what we're doing. Please bring me deals. How do you get a hold of me? Email don@crossroads-group.com and tell him you have a deal. He's going to put it in the chat right now. Tell him you have a deal. Here are the things I need. I need an ask price. I do not want to hear, well, what do you think it's worth? I need an ask price. If you give me the other four and you don't give me an ask price, you will be ignored. I need an ask price. Number of units, location, the unit breakdown, how many 1 bedrooms, 2 bedrooms, 3 bedrooms, and the average current rent for all the unit breakdowns. And then actually it's 6 things. The last thing I need is the last 12 months of expenses on the property, the actual expenses. You give me those, I will literally tell you in seconds if I'm interested or not. And when I say seconds, go on my LinkedIn, you will see posts. People will verify. They've emailed me with all 5 or 6 attributes and they get an answer in seconds. I gave a full price offer on a $14 million piece of real estate in North Carolina when somebody did this for me.
Shout out to all the viewers out there right now. We have some OGs following along. Good morning, everyone. We have some people in UK. Welcome to the show.
UK, what is it in UK? 4 o'clock now?
Ask questions if you have for Paul. We love
okay.
all the support, and as always, make sure you smash that thumbs up. Paul's bringing you content and has been for 2 years, and we're gonna get into that content right now. People have been falling in love with our stock analysis, our 8 pillars, and we're gonna go over a hot topic now. Not Hot Topic, the store. I know.
FYI, which was one of my first stock purchases ever, and it did very well for me.
I know you love shopping there, Paul. You got your ears pierced, your nipples pierced. You love getting rock and roll T-shirts at Hot Topic, but that is not the topic
today. Is Hot
today.
Topic still around?
I'm pretty sure.
Is it really?
We are talking about Costco today. Now, Don said Costco is a heaven to walk through. I do Sam's Club. I don't even know what I do. I think I do Sam's Club and Costco. But the point with Costco is they had record growth. Of course, people
record profit.
Record profit.
The first time they ever hit $4 billion in profit in a year.
Record profit. The stock is not as high as it was just a few days ago. So record profit, stock going down. What is the story?
By the way, so the reason is that we want to talk about this was I sent this article to Don and Seth and I said, guys, we need to talk about this in live stream because guess what happens? People always think that good news makes things go better. Then if Costco had record profit, why did their stock not go to record highs? Are they close to record highs? They are. But if you would think that during a pandemic, record profits, you would think, oh, the stock's going to go through the roof. Did it?
We have some OGs following. John, I love you. Thanks for commenting.
John Fessing?
On my polka dot shirt. This is my favorite shirt. If you're watching out there, this is from G-Star Raw, totally gangsta. And we have someone watching from the Netherlands, Paul. You're really reaching out there. The Netherlands.
I have actually a family in the Netherlands.
Shut up.
Yeah, I have.
You look Netherlish. Is that what it is? Dutch.
Okay. Yeah, my family is in Amsterdam.
Let's look
Amsterdam is the Netherlands, right?
I
Did I just sound very ignorant by asking that question?
I was the 5th grade geography B champion of my school, so yeah, I should know.
Pretty much the gangster of not in 5th grade up to 8th grade.
Pillar number 1 when we're looking at a company.
Well, before we go there,
Go ahead.
I wanted to show the whole year to date. This is Costco year to date.
Okay.
It's pretty close to its high ever, but you would think when they just announced record profit, it would just go through the roof based on what everybody else talks about with other stocks.
Right.
So why didn't this one? Okay.
PE ratio is pillar number 1. Let's talk about
boy.
it. We want this less than 20. 38.
38.7. That's a big one, guys. That is a big one. So the company is currently selling for $154 billion. That if you want to buy the full company right now, buy all of its shares, $154 billion. 38 times profit, guys. That is a big, 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 big number.
Not that big. It's not Tesla. Tesla's 1,000.
No, I know. You're right. No, yeah. But this is still a big number. This is for an established company that does retail. What's their margin here?
Pillar number 2 is profit margin. We want it to be, 2%.
So guys, in the grocery business, in the retail grocery business, margins are very low.
Okay.
So that's what I'm sitting there saying, Seth. A combination of a high PE with such low margin, it's a hard thing. And look at their gross profit. Their gross profit is only 13%. That means for every extra dollar they sell, they're only adding 13 cents to their bottom line. The grocery business is a tough business. It has very, very low margins.
Mm-hmm.
The great thing about Costco is, I mean, people talk about Costco like it's, like Don said, it's heaven. It is heaven. I love going there. I love going to Sam's Club. It's the same type of store. And people belong there. I buy my gas there. Do you buy your gas there?
I have a Tesla.
Oh,
Gosh.
what about your Honda?
Oh, Paul, it's been years. I can finally say that just like that. I just got you. I just fried you. Look at me. Yes.
What about your Honda?
Oh yeah. My Anaconda don't want none. Okay, Paul, these we're so
right now we're 0 for
PE
2.
And yeah, this is two
X's.
X's. Oh my gosh. Number 3. What, I can't see the damn list.
Revenue growth.
Revenue growth, pillar number 3.
You should have this memorized by now.
No, I left my list over there. Shit, I'm totally prepared.
Okay,
Revenue
guys.
growth over the past 5 years.
141, 152, 167.
Pay attention. It's going up drastically.
Yes.
$167
So
billion.
one of the things I want to look at this is big growth for such a big company. I want to understand how much of this is same store sales. What does that mean, Seth?
Same store sales? Never heard of that.
Same store growth. So what you want to do is how much of this growth is because they open new stores versus how much of this growth is because the same store. So I want to look at the same stores from 2016 to today. How are those stores doing? That's how you'll see how because anybody can grow by opening more stores. But if your current stores are losing in revenue, decreasing, that's not a good thing. This is still a very big positive to start with. I love this. I love the fact that it's growing this much. But we got to figure out how much of that same store growth.
If you're watching, please smash that like button pretty please right now. We really appreciate
Because
your
I
support.
look at our likes and how much they're increasing over time.
Oh, Paul, look how cute you are with that. That was wonderful. Yes. Some people are saying they're afraid to ask dumb questions, so they like that I do, and I'm not afraid to be a dummy. Paul, I brought this
There's
up
no
to
such thing as a dumb question.
I brought this up to a mutual friend of ours who's doing close to $2 million in business pawning Magic the Gathering and Pokemon cards. And I said, man, like, who do you turn to? Because I call you for every life event in my life, whether it's taking a job, investment. You've been my liaison for the past couple of years, and I really appreciate it. And people are appreciating it as well. So smash that like button. And guys, if you're watching along at home, make sure you put some questions in. If you have some questions right now, we're here to ask them. If you want to see a stock analysis.
Actually, I'm going to go so far as to say this.
Go ahead, Paul.
Whatever question you think is dumb, I insist you ask it because it's probably not dumb. We just had the guy speak to our company, the guy who was in charge of SEAL Team 6 that killed
I'm sorry
them.
I missed that event, by the way.
That's okay. It was pretty cool. But the guy literally said in one of his first meetings ever, he was learning something. He stood up, asked the question, and he thought it was a dumb question. Later on, he left the room, and everybody came up to him and said, "Hey, thank God you asked that question because I was thinking it. I didn't want to ask the question.
Mm-hmm.
Just ask the effing question." It's the whole cliche.
Okay.
What's the next one?
Pillar number 3. So we did PE bad, profit growth is bad.
Yes, but revenue growth is very good.
Revenue growth is very good. Green check mark for revenue growth. I love it. Yeah.
Okay, what's the next one?
Okay. What about profit growth over the last 5 years?
Okay, this is a good one, guys. 2.35, 2.68, 3.13, 3.65, 4.
Massive profit growth.
And look at the previous 5 years. 1.46, 1.7, 2.03, 2.05, 2.37. They have very consistent profit growth over the last 10 years. It's almost triple. It's almost tripled in 10 years.
Wow. I mean, for a grocery store chain?
They're probably going a lot of locations, guys. To me, this screams that this has got to be a lot of locations.
How about pillar number 5? Shares, number of shares outstanding. We want this to be decreasing. As
436 million, 442 million. It is up slightly.
Nominal
1.5%. I'm not worried about this.
So this is a meh or a green check mark?
Yeah, I'm going to put a check mark on it.
Okay,
Doesn't matter to me.
shares.
This is very small. You're talking about 1.5% of their extra shares in the last 10 years. Don't
Okay.
care.
Pillar number 6, total current assets greater than total current
What
liabilities.
would you guess this is going to be?
Assets. I mean, I would think they have more liability than assets.
I would guess the same
because
thing.
they have
Total
to shelve
current.
it and then sell it.
I'm going to sit there and guess that current. So right now, total current assets is 28 billion. Okay, $28 billion. Total current liabilities, 24.
What are the two numbers? 28 and 24.
28. Well, 28 and a half and 25.
Oh, they're over.
Yeah, check mark there.
Wow.
I'm kind of surprised by that.
Assets.
I thought
are
it'd be
good.
lower.
Nice.
All right, good.
How about free cash flow growth?
Okay, now this
average.
Now this is why I like this one.
Go on.
This is a good one to know because of such a low margin. I want to see a healthy free cash flow because with low margin, you need to be able to have a good buffer. Okay, so this is important. So Seth, please explain to everybody what free cash flow is.
Okay. Free cash flow is the cash from operations minus the capital expenditures. And if you followed along our podcasts over the past months, I have no idea what that means, but I've memorized it, and you can learn what it is right now too as well.
Over the long haul, free cash flow and net income should be very equal, very similar. So in the last 5 years, we did let's call this 2 billion, then 1.7, 4.2, 3, 2.8, and 3.4. All right, so it's pretty healthy. It's very similar to their net income. They don't have, I mean, it's a big chunk of their cash from operations, but I actually like this. It's up. It's had a little fluctuation, but it's up. I'm gonna give it a check mark.
Green check mark for free cash flow growth.
Yep, free cash flow growth.
Oh, we're looking really good here.
We are.
How about number 8? Price to free cash flow less
Remember,
than 20.
They were selling for 150 billion, right? That was the market cap of the company. What's the average of the last 5 years? So what we're doing now, instead of the 15 times, we're going to go and look at the average of the last 5 years and multiply that by 20. Because when you're looking at 5 years, you're going to see steady growth. You're going to take out some fluctuations, et cetera.
Say all that again, because for our simple-minded folks like myself.
So I don't want to look at the most previous with 1 year and just and say, okay, it's 1 year can have any aberration possible.
This is price of the stock versus free cash flow.
About now, but I'm taking the free cash flow as the average of the last 5 years.
And we want this to be around 20.
Yes. I'm also increasing the price of free cash flow from 15 that we wanted to 20 because it's an average of the last 5 years and you expect there to be growth. So the average will be lower than the previous year is the expectation.
Go ahead and hit it, baby, then.
Well, so what is this?
Oh.
3.7, 7.9, 10.7, 14.1 divided by 5 equals 2.8. Yeah, 8 times 20 equals 56 billion.
56.
It's selling for 150 billion. This is the biggest monster X of all time.
Did this just kill the whole deal, Paul?
Yeah, this is awful.
Tell me about it. I mean, because again,
So-
simple-minded me.
Yeah, so right now it's selling for around 55 times free cash flow over the last 5 years. Even on the previous year, it's still selling for 35 times, 38 times, which is last year's, which is actually the PE ratio. Guys, this is too expensive. This is just way too expensive.
Marcos asked, what do we do after we analyze this? Say we're good. Marcos asked, what do you do after you go
Great
through
question.
8 pillars?
So there are certain pillars that matter more than others. This one to me and the PE are big X's. I'm going to sit there and say I'm not going any further. Unless there's some story. If it was a small company that had a lot of growth potential, I'd say, okay, maybe they can grow into their value. This is already a very mature company. How many locations they already have? They have thousands. They have, I mean, maybe not thousands of locations. How many locations do they probably have? Can somebody look it up, Don?
Mm-hmm.
The whole point is, if you determine that you then go, okay, this looks pretty good, you need to do more research. What's that research? Read the 10K. Go look at their prospects. They have
Say it again, Don.
785.
They have 785 locations. Now, relative to Walmart, they have a lot more growth potential. So you might sit there and say, listen, I like the growth potential. It's possible. I just look with the low margins, the high valuation. It's hard to make this thing work. I'm not a buyer at this price. You might not like my answer. I'm probably a buyer around, I'm starting to look at it at 125 to 150. And it's currently at 345 or something like that. I need a massive drop. And you might sit there and say, Paul, it's not going to happen. You never know.
Go back and show me.
It happens. When was the last time it was at 125 to 150? Let's look. But from here, if you determine you want to look at it, like if you look at our other videos, Marco, you go and then start doing more research to understand more about the numbers behind the numbers. Or I've made purchases before is looking at this. Now, if it's so obvious, I'm looking at it going, okay, I'm going to work with this. Let's look at the last 5 years. Oh, I mean, in the last 5 years, it was well under 120, 150. You might sit there and say, well, yeah, but we also had a big stock market boom this time. So I don't think this is completely out of the possibility of it being at this price at some point. And don't forget, in 2 or 3 years, if we have a bear market and this price goes down, but Costco keeps growing and their profit keeps going up, what happens? At that point, if the price goes this way, but the value goes this way, it might be worth 200 and you might be buying it at 200. Very possible. Your job as an investor, though, is to look at thousands of companies and determine the 20 or 30 that really work in this metric, and you will find them.
Guten Tag to our Freundin in Deutschland. Guten Tag. We have Germany, people in Germany. Yeah, it's amazing. Okay, a couple folks are asking about Alibaba. We really appreciate your comments. We would certainly appreciate you guys if you give the video a thumbs up.
Who's my boy who asked for Alibaba? I told him to keep asking until we did it.
I think it's Ramon.
Was it Ramon? It was Ramon. I think you're right.
So, prefaces, I've never heard of this. I don't know what you guys are talking about.
Over here. How do we get Alibaba stock? What's the ticker, Ramon? What ticker do you want me to look at? Oh, Baba. There we go.
Baba.
Which is Arabic for father.
Oh, okay.
Okay. So I'm going to make a comment.
What is Alibaba before you start? Oh, go ahead. Go with your comment.
You know what Alibaba is?
I do not at all.
Alibaba is the online marketplace. They call it basically the Amazon for China, but it's where like US people go to source overseas product development. All of our overseas business started basically on Alibaba, of us sourcing, talking to people, etc. Okay? I'm going to make a comment.
Go on.
I'm always apprehensive about Chinese-based companies. China has a history of...
That's because you're a racist.
That's exactly what it is.
Mm-hmm.
China has a history of manipulating their numbers and not disclosing the real numbers.
Okay.
I say that, Ramon, with amazing, like, okay, let's make sure we understand that going into it. I'm not saying it. It sounds terrible to say, but it is actually evidence and true that these things, look at the recent COVID issues. They manipulated those numbers as well. They didn't disclose how many people really had it. So anyway, are we going to do the full thing here?
Adam is watching from the Czech Republic. I didn't know that was a place. This is incredible.
Who's a xenophobe now?
Actually, I'm Hungarians. I'm just joking. I know exactly.
Of course you know what the Czech Republic is.
Okay, you want to do this?
Yeah, let's do this.
All right.
By the way, do we want to do the 8 pillars on this one?
I think so. Many people have been asking.
All right.
Pillar number 1.
PE.
PE less than 20.
30.
Already too bad?
It's already an X. I mean, listen, Alibaba is a fast growing company and they will grow. Jack Ma has grown this thing into like astronomical numbers. So maybe it's a lot, maybe it's not. We'll see.
Profit margin, pillar number 2.
Huge.
31%.
31%, guys. This is a big check mark. This is awesome. This is a big, now I will say, concern I have is gross profits. This is already a red flag for me. I'm already concerned about manipulating numbers.
Hold on one moment. Don, how's the feed look over there? Are we okay? Okay, great. I got a choppy on my end. We'll keep going. Pillar number 3 is revenue growth over the past 5 years.
I'm willing to bet this is going to be astronomical.
Okay.
So we're going to go to the financials. Oh, my lordy.
Okay.
Oh, my lordy. 16, 23 and a half, 38, 56, 73 billion.
Jesus.
Yeah, Jesus is right. That's huge. Big check mark there. Next one.
Profit growth over the last 5 years. Pillar number 4.
Ready to get a little wood? 11.2, 6.5, 9.7, 13.1, 21. The previous 5 years, 264 million, 660 million, 1.4 billion, 3.8, 3.9. Yeah, this is astronomical. Massive 2 check marks right there for revenue growth and profit growth.
Wow. Shares outstanding.
And I'm willing to bet this one's bad. No. Holy Toledo. Look at this one. 5 billion. Ooh. 2.3, 2.3, 2.2,
What's it?
2.3,
Wow.
2.45. Now I will say this. I'll be the negative guy.
Go on.
They had 5 billion. Now they have 2.6. You think, oh, it's in half. But look at the previous 8 years. After that, look at the previous 7 years, 6 years, 7 years. 2.17, 2.33, 2.4. So they're uptrending again.
Uptrending.
So even though from 10 years ago, I'm still going to give this one an actual X because they're starting to increase the number of shares outstanding. Even though it's down from 10 years ago, I'm actually going to give it an X because the last 5 or 6, 7 years has been a pretty good amount, 30%, 25%. Next one.
Pillar number 6 is total current assets greater than total current liabilities.
Balance sheet, quarterly, current assets, 69 billion, current liabilities, 35 billion. Massive, massive, massive check mark.
Okay, we're looking good, Paul.
We are looking good.
Number 7, pillar number 7 is free cash flow growth.
Okay, free cash flow growth. So what's free cash flow stuff?
It's cash from operations minus capital, capital expenditures. If you're
That is-
if you're watching there, we appreciate your comments. We will get to some of these. People are asking about IBM, Paul. People are asking about GPS, whatever that is. And
it's not Garmin.
if you, yeah, a Garmin. Oh, go ahead. I love Garmin. Keep watching, guys. We're gonna get to this. Keep going, Paul.
Okay.
We are on free cash flow growth. Oh my goodness, 7
yeah,
to 14.
it's huge numbers here. Huge numbers here. 15 and 8, 19. We'll call it.
Wow.
These are big jumps. This is a massive check mark. They have made, and by the way, when you see big earnings and big revenue, you should see this. So this is a good thing.
Price to free cash flow.
Okay.
Price to free cash flow
So
at 20.
we want the average of the last 5 years times 20.
Okay.
Okay. What's the average here? Let's just do an estimation of the average here.
Ramon says, hope these numbers are true. Keep going, Paul.
That's exactly it, Ramon. So 13 billion is about the average. So we want it to be less than 20. So 20 times 13 is 260. We want Alibaba to be worth less than $260 billion.
What's it at?
It is currently at $751 billion.
This kills everything.
Yep. So this is exactly like the PE ratio.
Yes.
This is way too high.
This is like Costco.
Way too high. Even on the most recent one of 19 billion, they're still at 37 times free cash flow. This is an X. So, Ramon, I will say, assuming that all their data is correct, this is exactly like Costco. This is a big X for me. It's just now, can it grow further? It can still grow further, but one of the things we're going to do at some point, as part of Everything Money, we're going to create a website and an app that will allow you to put assumptions in to determine what needs to happen to the company to justify these prices. And I think right now you're banking too much in the future for that one. I'm avoiding Alibaba at these prices. What am I buying Alibaba at? Probably, 90 to 120. I'm looking at Alibaba saying when it gets to 90 to 120, I want to take a look at it. The good news is it was 90 in 2017, 120 in 2017. It was there recently. And this has been a very fast growing stock that's jumped up. They got great margins, assuming you believe everything. No dividend yield, not a horrible thing, but I just look at it going, this is an avoid for me right now.
What is AbbVie? AbbVie?
Oh, AbbVie?
What is that?
Aren't they pharmaceutical? No, are they the drink company?
You want to look them up?
Yeah, what is it?
People are asking.
Is it AbbVie? Is it pharmaceutical?
Looking at selling, he bought it at 190, but he's thinking about selling.
Alibaba.
So Ramon, I will say this. Take this with a grain of salt. Momentum can be big on companies like this. I don't know if you should sell or buy. You can make that decision for yourself. I would have never bought it at 190. I don't mean that as a criticism. I mean it as listen, stocks can go, look at Tesla, look at Amazon. I wasn't buying them back in the day. And most people would say, oh, do you regret it? No, I don't regret it because I understand the value. You have to determine what makes sense to you and go do that. I'm not buying Alibaba at 200 and some. I wouldn't buy it at 190 though. But if you like it, maybe you take some profit. I don't know what you do with that. I can't really tell you that answer, but I'm just sitting there saying that's all on you. I hate to say that. And I know you want me to say do this. I'm never going to tell you that because I've been wrong in the past. I'm just telling you what I would do. I'm not owning the stock.
Yeah, guys, I want to be very clear if you're watching to get the mindset. It has taken me 2 years to sort of understand this. The idea that Paul plays a very safe, calculated basis of investing, where if you did this 100 times, you would make money. What he doesn't do is chase down really high-end, overhyped, popular stocks like Tesla.
I don't do that.
Because yes, we may be missing out on Tesla. In fact, I am missing out on Tesla. Paul, I had 140 shares many years ago.
I know, you're welcome.
And so we're taking really, again, the tortoise versus the hare. We're taking the slow, steady approach to gaining wealth.
Yeah, and again, it's what makes me feel good at night. I feel good at night knowing that I'm buying companies, right? Every single company that I own currently, I actually hope their price goes down because I want to buy more shares of it because I think 3, 4, 5 years from now, they'll be a lot higher. So my mentality is a lot different than everybody else's. I will literally have friends of mine. What are you laughing about?
Well, Ramon brought up the moment of likeness we used to do. The moment of likeness where everyone smashes the like button.
Right, smash the like button, subscribe. We really need those things. I have no problem doing this stuff for free, but we really want to get to 1 million subscribers. It ain't gonna happen by everybody just like saying, thanks, Paul, you gotta like it. And Ramon will verify I'm very active in commenting. Whenever it's signed PG, that is me commenting. I do it all the time. I love it.
Let's talk about AbbVie.
Okay, so AbbVie is a pharmaceutical company. Now, the thing to know about pharmaceutical companies, and whoever asked for this, I'm really glad you asked.
Okay.
Pharmaceuticals is all about what's their pipeline. What do they currently have they're selling? When do those patents expire? And what's their pipeline, either what they're creating or what they're buying from other small companies. So we're only going to look at pharmaceutical companies based on what the financials say. The next step after we determine if we want to buy it is, okay, we got to understand their pipeline. You can do this by reading their 10K, listening to investor calls, and talking to their investor relations.
Paul, I'm going to be honest. I don't think no one's going to do that.
I know. But guess what? Over time, we will do more and more of these.
Wouldn't you have to say, I've watched a lot of videos, and maybe our viewers can agree, this is by far an incredible overanalysis of each individual stock.
See, I don't think it's overanalysis. I do this in a matter of 30. The 8 pillars we do, I do in 30 or 45 seconds because I'm so used to it.
We are going to come out with an app. Paul and I are already talking about developing this app where we're going to be able to just plug and play.
We'll be able to type in I have to find a feed company, a company that'll give us the feed. So we can basically, you can type in any ticker symbol and it'll give you all 8 pillars and give you the check marks and the X's and all that stuff. Mm-hmm. It's not a way of saying, go do this. It's just a way of saying it's a good filter. And this seems like a lot of effort. It is effort, but investing should be effort. And also, I think you should invest in individual stocks if you really feel like playing with a little bit of your money. The rest of your money should be in broad-based market index funds. That way you can grow with the market.
I see the thumbs up going. We really appreciate it. I would say too, guys, I watch Graham Stephan. Where people are talking about Graham Stephan smashing that like button. Graham Stephan is heavily scripted. This is Paul's knowledge getting thrown stocks right at him. And
we're live right now, which happens, but even our videos are
absolutely
not scripted at all.
So you can see the information you're getting straight from the source here. And trust me, I feel very lucky to be sitting here learning from Paul. I tell my wife, I feel like he's just teaching me.
Adorable.
We actually set up this camera over top of my shoulder here because Paul loves educating. I love listening. And so I want to play the role as you as a viewer. So please ask questions and I'll ask them to Paul. We're doing great. We will get to IBM, GPS. I love this, Paul. Let's talk about AbbVie.
Okay.
Pillar number 1, PE ratio.
We want it
less than 15.
It's won't we want less than 20? Don't we want it less than 20 or 15? 20.
20? Sorry.
18.5.
Very good.
So it's a check.
Now isn't this a telltale already that with PE is good? I'm assuming a lot of the other numbers are going to be pretty good.
It'll help, but look at the next one.
Profit margin.
Negative 7%. Okay. That's an X, but I'm not worried about it right now. And here's why. To see this I can already tell it's based on the most recent quarter. We should be looking at profit margin on a yearly basis. The most recent quarter is negative. So let's go really quick to net income. Where's net income? 7 billion in the last 7 months, in the last 12 months, 7 billion, and the revenue is 36. So it's definitely, 7 billion divided by 36 equals 18% or whatever it is, 19%. It's a check mark.
Green check for number 2.
Green check mark. 2 of them. We'll have to figure out why they lost money last quarter, but we'll figure that out. But right now, it's a green check mark.
Revenue growth over the past 5 years. Pillar number 3, revenue growth.
Now, AbbVie is a big company, $150 billion company in terms of their market cap. Let's look at their financials. So, last 5 years, 23, 25 and a half, 28, 32.75, 33.27. Chickadee check.
Chickadee check yourself before you wreck yourself. Did you like Ice Cube? I mean, that album, the Predator. You
I
weren't
had
into
no
Ice
idea.
Cube,
I
like,
wasn't an Ice Cube.
oh my
But
god.
today is the 2-year anniversary of
Dr.
Jay-Z's
Jay-Z. Yeah, you like that.
that album.
Yeah, if you haven't listened to Ice Cube's The Predator, oh my god, what an album. Okay, we'll keep going, guys.
Net income growth.
No, profit growth. I'm sorry.
Profit growth, net income.
Same thing, sorry.
Yep. 5.1, 5.6, 5.3, 5.7, 7.9. I'm giving this the chickadee check. Even though it's had a few drops in here, been very consistent and growing. Previous 5 years, same thing. It's still growing. I give it a check mark.
Pillar number 5 is shares outstanding. We want this decreasing, Paul.
Okay, shares outstanding. Let's see if we're going to get disappointed here. 1.58, 1.58, 1.58, 1.59, 1.6, 1.6, 1.62, 1.6, 1.54, 1.48.
What do you think?
So it's down over 10 years, and the last 5 years it's down. They were increasing a little bit, and now they're back down.
Shares, this is great stuff.
So I'm going to give this another check. It's a little weird. I want to find out why they were increasing back then. Were they making acquisitions, whatever they were doing? But I'm still giving it a green check right now.
Total current assets greater
Do
than
we have
total
any
current.
negatives right now? Do we have any X's?
No, all 5 are doing great. Total
Wow.
current assets greater than liabilities. This is money in their bank versus money they
I'm
own.
trying to figure out if this is going to be a plus. I think it's going to be. I think total current assets is going to be more. Okay, total current assets 21 billion. Total current liabilities 24.5 billion. It's negative. That's our first X, guys.
Mm.
Now it's probably the way that company is. Although their current liabilities have jumped up a lot in the last year, in the last quarter. They went from 16.5 to 24.6. Ooh, that's a red flag.
What were they doing last year? At 16.
You know what happened? You know, I bet happened.
Go on.
They might have some. Oh yeah, something's wrong here. Okay, so you want to understand this guy. This is why we look at these. Okay, so look, last quarter. This is not. I'm looking.
Some sort of acquisition with an allergen, M&A, large debt because of M&A.
I will tell you, their cash went down big time. So they did make a big acquisition of some sort.
Yeah. Say that, Don. Say it, Don.
I'm just asking Paul, can you highlight that on the
So right
screen
here,
the viewers
guys, if
can
you look
see
at
it?
this, they had 40 billion in cash, 41 billion, now 6 billion. This is big. This is a massive check mark, kiddos.
Number 8 in the final pillar is price to free cash
So
flow.
26.
Average.
26 and 9 is 35, and 6 is 41, 48. 48 divided by 5 is 9.6.
9.6, well below 15
times
to
20
Oh, shoot.
equal. Yeah, so now 9.6 is their average free cash flow in the last 10, in
192.
the last 5 years.
192.
So 192. And what were they worth?
I can't remember.
153.
Uh-oh.
Check mark.
What?
They're worth 153.
Oh.
We want it to be under 192.
Oh my gosh, Paul. This is a buy. You're buying this right now. Go on Fidelity.
I'm not buying this right now.
Tell me why.
I have to understand what their the big thing in pharmaceuticals is what's their pipeline of drugs. What drugs so one of the things, guys, is Pfizer, Viagra, right? Did you want to buy Pfizer when they were losing their biggest drug profit generator in 20 years to patent to going generic? Of course not. So you have to understand this. All the financials here, though, I do like. Now, Mo, my good friend, considers himself a biotech expert. He had some issues, I think, with AbbVie as to why he didn't like their pipeline. But all financials wise, guys, we had 7 check marks and 1X. And what was the 1X? The total current assets versus total current liabilities. That didn't bother me. So the 1X wasn't even a bad one. This is a very good financial company. So whoever asked for AbbVie, thank you very much for giving it to us. From a financial perspective, it looks pretty decent. Again, though, you have to look at their sales and what's coming in the pipeline. Investing isn't just about picking these numbers and saying, oh, I'm going to make my decision based on these numbers. It's about understanding what's behind the numbers.
We apologize for the choppy feed. A couple people are saying it's a little choppy. In general, we just analyzed AbbVie, the tech the Merck company. Why am I calling it Merck? I don't even know. I'm sorry.
The pharmaceutical company.
Pharmaceutical. Sorry. Yeah, pharmaceutical company. And of our 8 pillars, we had astoundingly great check marks for 7 of them, but their liabilities was greater than assets. And as we're learning, it's maybe because of big acquisition, a $63 billion acquisition.
Yep.
So they lose patents in 3 years, people are saying. Oh,
okay. Really?
Yeah.
Oh, see, that's a big deal. Are those the big money makers they're losing the patents on?
I'm not certain, Liam. Maybe you can.
See, this is why it's good that we have this YouTube live, because then everybody else can do some research on it while we're talking.
Why do you think people are willing to pay for 30+ PE ratios?
Is that a question being asked?
Potential growth, popularity.
People think, yeah, it's popularity. It's like, remember, people don't realize, most people don't even look at PE. Most people just look at a stock going up and up and up and say it'll take care of itself. And if a company has amazing growth potential, you should be willing to pay a higher premium for it.
I'd like to do a couple more. Can we go to IBM, please?
Absolutely.
We can't thank you enough, folks, for watching. We appreciate the support. Paul is going to be giddy with excitement learning how many people are on right now and how many thumbs up. Please smash that like button. With pretty please with sugar on top. It's very important for the algorithm, which no one can actually define that word. In the history of the universe, no one knows what it means. We just keep saying
Isn't algorithm just an equation?
That's what I thought. So it's like from like Calc 2, which
X
we
plus
were
2
in
equals
together
4.
in 1998, Paul, you and I.
We weren't in Calc 2.
We were.
No, we were in AP Calc in senior year.
Oh, AP Calc, yeah.
Yeah, Calc 2 I took in
Where
college.
did you sit? You remember?
Yeah, I was second row from the right.
I was too.
I was second seat,
I
all
was
the way toward the window.
I was in the back.
Oh, you were in the second row on the right?
I think so. I was in the back, yeah.
Was it alphabetical?
I
I
don't
don't
know.
think so. Remember Novoa was like,
A dear friend of ours. We
Yours.
digress. No one wants to hear this bullshit.
okay. I think people do.
Let's get on to IBM. Yes, folks. Paul and I went to high school together from 1995 to 1999.
I lost my virginity to your daughter. Don, you were there.
If you know what that's from, put
No,
it in the
no,
comment.
not 100. No, because that one's too easy.
Do you know where that's from? Paul will reward you greatly when he shouts out movie quotes. I know John Thexton's going to get that in a heartbeat. Okay. Listen, Paul and I were in high school together. We were not homies, Paul. I don't think we hung out one time. Did I see you at a party at one point? Maybe not. I mean, I was a super jock. You were a super chess
Nerd.
player. And but I would say I had great respect for you.
You didn't
as a
know who I
person.
was.
I did very much so. I'm glad that our paths crossed recently. Well, how recent? It's like
I am
5
too.
years ago.
It was right after the Cavs won the title.
Yeah.
4 years ago.
Amazing.
December of 16.
Oh, somebody got it, Tommy boy. Oh,
It was.
John Thomas beat you to that. Oh, throwback 95. Oh yeah, I love it. Great. Okay, what are we doing? IBM. Let's do it, Paul. Pillar number one, PE ratio.
13.7. Automatic check.
Perfect. How about pillar number two? Profit margin. What do you think? It's a meh.
I will say this though, the profit in the quarter was 7.5. What we need to start doing is looking at the trailing 12 months. 7.8 out of 75. That is over 10%. Check mark. So I'm going to stop looking at the quarterly profit margin. I'm going to start looking at the net income divided by revenue for the trailing 12 months. So this is a check mark.
Great.
So 2 check marks so far.
Revenue growth over the last 5 years. Pillar number 3. Let's do it, baby. John Thessing is a videographer here in Ohio. Paul, he's watched so much of our show. He should just come. John, just
He
move
wants
here.
to come.
He should just be on the show with us because he corrects everything we say. He said, for Christ's sakes, an algorithm. He gave us the definition for an algorithm. It's like,
Well, if I had Google in front of me, I'd be able to do it too. What is the definition of
ooh,
algorithm?
I'm not going to read it. Just keep going. Profit growth over the last 5 years.
Revenue
Profit
growth.
Revenue growth. Go.
82, 80, 79, 79.6, 77.
No.
Now, I was expecting
look at
this.
the
Big companies like
look
this,
at
if you guys
the-
remember when we did AT&T, they had declining revenue, I believe, or it was very stable. This is a big company. IBM's a dinosaur. It's not the worst thing in the world. In fact, I'm still going to call it a red X, but it's not the worst thing in the world. Next thing.
Okay. Profit growth over the last 5 years.
Okay.
Well, if they're losing money, are they growing profit?
Well, they're not losing money.
I'm sorry,
Their
they're
revenue is
making
decreasing.
less.
Yes. 13.2, 11.9, 5.75, 8.7, 9.43.
Uh-oh.
It's an X. And if you look at the previous 5 years, it's decreasing also. They might have sold off divisions, et cetera, but it's still an X. You still have to assume some things about this. And this is one of the things that even if the ratios work, like the PE ratio is 13, we'll look at the free cash flow ratio. If it works, you want to understand why is their revenue and profit going down? Are they selling divisions off? Are they focusing their attention more on better business?
How about shares outstanding? Are they decreasing the number of shares, thus increasing the value of each share?
With how much this is going down, revenue and income, it's very important that we see shares outstanding decreasing by a lot. And it's decreasing, but I won't say by a lot. 1.26, 1.2, 1. Blah, 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 887. So it's down about 30%, which is actually, it's a pretty good amount.
Okay.
30% drop. I don't know the exact number, I'm just estimating, but it's
Free-
about a 30% drop.
Okay. Free cash flow growth. Do we need to go forward, Paul, with so many bad X's?
No, we do, because this is still, free cash flow is the one that's going to make or break me.
Okay.
Because the two biggest ones are free cash flow ratio and the PE ratio.
Okay.
Because yeah, so I appreciate you asking that question, but on the 8 pillars, they're not all equal,
Okay.
right?
Okay. Got it. That's
Okay.
funny. The pillars should be equal. Maybe this is a little pillar.
Yeah.
Free cash flow growth, pillar number 7.
Okay. So, ooh, look at this, guys. They have good free cash flow. So 13, 13. I'm just going to start like 13, 11, 12. So it's an X, but it's got a very high ratio of operating cash to free cash flow. So it's an X, but it's a small X. Now, what's the next one? What's the final one?
Price to free cash flow over the average over the last 5 years,
So it's roughly the average is 12.5, right?
less than 20.
So
Mhm.
times 20 equals 250 billion, right?
Yes. Yes.
Okay. What's the company currently worth?
$100 million in gold bullion.
107 billion. And this is why we don't discount it. This is a massive, huge check. So IBM is not a sexy company. And that is why it's not selling for a huge number. It is currently selling for 10 times free cash flow right now.
Holy cow.
So this is a good thing. Remember, guys, companies that are going down in revenue and profit, but still making revenue and profit are still worth something. If I told you today, you can buy a company that's going to make $5 a year for the next 5 years, and afterwards it's going to do zero, you shut it down. Does that mean it's worth zero? No, you're still going to make $5 a year for the next 5 years. It's still worth something.
Mm-hmm.
Maybe it's worth $10. Maybe it's worth 15. It's not worth zero. So this is a prime example. The market likes seeing growth. They don't see growth. They sit there and say, oh, this sucks. Now, I'm still not a 100% buyer of this company. But what I am is I'm a guy who's going to do more investigation as to why their revenue is going nowhere. Look at their stock price. Their stock price in 2000 was here. Their stock price today is exactly where it was in 2000. But they're paying a nice dividend here, guys.
What is it?
5.4%.
Wow, IBM.
5.4%. This is definitely a company to look into. You will be bored with this company. It will give you a good dividend, and it might not go up in value a ton, 2 or 3%. In the last 20 years, it's gone nowhere. So you just got to remember that. This is not a company for those people out there who are looking for big gains in stock price. If you're looking for a nice dividend, it might be a good play for you. It seems like their dividend is very safe because they're worth $100 billion. They're paying 5%. That's roughly $5 billion a year. And remember their free cash flow, which is what they use to pay dividends. Their free cash flow last year was $12 billion. So they pay $5 billion off the $12 billion. They still have $7 billion left over, right? They made a huge acquisition this last year. They spent $31 billion last year. There's a big acquisition. They spend money on acquisitions, guys.
We really appreciate you guys smashing the like button, the gals out there as well, and people overseas. Paul, why do you choose Y charts over Yahoo Finance? Is it just for the speed?
Yeah, it's just everything's organized much better for me.
So Paul pays hundreds of dollars for this
A
a month for this feed, and he's giving it to you guys for free, so we don't have to juggle through the Yahoo Finance with the ads and all the BS.
I mean, there's other free Google Finance. If you guys Google, free financial data, it's all out there. Listen, you can go get it yourself on SEC.gov. I like Yahoo Y charts. It's all just organized for me the exact same way I like doing it. Like I look at looking at 10 years at a time, etc. But whatever you want to do, or just listen to us.
Dave asked, do you ever buy Canadian stocks like Air Canada or just US stuff?
I only buy there's too many options in the US. I would buy Canada though. I've never looked at Air Canada, but it's an airline, so let's maybe not go through that one right now.
Let's go to GPS. People are asking about GPS.
Is GPS Garmin? Did we determine that was Garmin? Or no, Garmin is it's Gap. GPS is Gap.
Oh, really?
Yes. So Gap is retail, which is a little bit of a hard one right now, but we'll look at it.
Okay. Pillar number 1, PE ratio. Uh-oh.
Negative. They have no income. They've lost money in the last year. They lost $1 billion. Their gross margin is pretty good though, 35%. So guys, we're starting off with 2 X's. No PE because they lost money, and no profit margin.
Now let me stop you right there, Paul. Again, I ask you this all the time, so tell me and the viewers again. When a stock is trending drastically upward, it's very, very popular. Everyone knows all about it. That's when we're not buying. The companies, well, not necessarily high flying, something like a Tesla, but Amazon, high flying, lots of profit, lots of revenue growth. The stock prices
By the
out
way,
of this
they
world.
just recently started making a lot of profit, but go ahead.
So Amazon, you said, right?
Yep.
Yeah, I got it. So like that's when we don't buy. So a company that's in the tank like this, again, I ask, like, how do we walk this thin razor line of like they're in the tank or they're about to go out? Now do I buy? I mean, like it seems like this again.
It's
I've
hard.
asked-
Remember one thing, everything in stocks is about pendulum swinging from euphoria and excitement. There are companies out there that just aren't sexy that grow very consistently. If you want that, Gap's not it. I don't think we should go to GPS much more. This is if you want to try it, guys, go for it. But this is a company that it's going to be hard for them. I mean, look, we already have the two major things and it's already not working.
But what about in good time? What about non-COVID? What about next year? If there's
Listen,
a vaccine, it comes back.
Okay,
What's the
let's
story?
go annual.
Just give me a little bit of a GPS.
They made decent money, but look at last year. Last year their profit was down big time, and last year was pre-COVID, and their profit was down 65%.
What do you mean profit down? Look at that. In those where am I looking?
Profit down right here, $1 billion in 2018, 350 in 2019.
Oh, I see. Sorry.
You see what I'm saying?
Yes.
And then look, 1.2, 833, 1.1,
Oh, so 10
1.2,
years ago. they
Yeah,
were making,
I mean, this is fine. I'm just going to do a quick one on this one. I'm just going to look at you guys, show you guys how I do this one very quickly because I don't want to spend too much time on this. Oh, yeah, see you later. You have like no free cash flow. This is a hard one, guys. No free cash flow, balance sheet. How much of their balance sheet is inventory? 5.3 balance sheet, total current assets, current liabilities. It's not terrible. How much debt do they have? Boy, they got a lot of debt, guys. And their debt has jumped up a lot in the last few years. Their debt at the beginning of 2019 was $5 billion. Now it's $11.5 billion.
what is your favorite boring dividend stock? Is it AT&T?
AT&T was pretty good. I mean, look at the IBM one was pretty good. I had to look more into that one. I don't know. That's a good question. I like dividends if the company is boring and just generating a lot of free cash flow they can use to give back to investors and they're already big. But I like companies that pay a moderate dividend that have growth potential and they can easily support that dividend.
Someone asked about what is this? They just said, can you analyze O, which is Real Income Corp? Do you know what this is?
The ticker symbol is O?
I don't know. Someone asked. Maybe you guys, maybe whoever did can elaborate. But meanwhile, what about DA Corp? IDA? What is that?
IDA? What do you mean IDA?
I don't know. So people are asking. I mean, obviously they're very people online, which we love you. Thank you so much. You know,
What do they need to do, Seth?
well, they are, Paul. They're smashing the like button like crazy people. It's incredible. And but
Let's look it up.
Idacorp.
I've never even heard of it.
Okay, let's take a look. Idacorp. Oh, okay.
Idaho? Hudaho?
Idacorp.
It's in Idaho. Look at that.
You're kidding. Of course. It is.
Idacorp is a holding company that through its subsidiaries acts electric utility engaged. You're gonna hate me. I don't know I don't know banks, utilities, and insurance companies. Those are ones I have to learn still on how they operate. Because the cash flow in these things isn't like everybody else. I bet you this utility data is probably pretty. Oh, okay, not bad. Should we go through it just from the 8 pillar standpoint?
Yeah, people are saying IDA is a utility. They're thinking about it.
Okay, let's look through it.
Oh, and Llewellyn said, "Oh, is Realty Income Corp." I don't know. People are also asking about 3M, which my company DGF
Oh, 3M.
supplies to 3M.
3M is a good company. We should look at 3M too.
And CVS, my son's favorite company.
Wow, time flies when you're having fun. It's already 11:50.
I know we're jamming here, and I guess people are still wanting more. So
Okay,
we're gonna keep giving.
IDA, Idacorp,
Idacorp. Pillar
First
number one is
one.
PE ratio.
less than 20. It's 17.3.
How is the profit margin? Pillar number two.
235 million on 1.2 billion. That's 20% almost. Check mark again.
How about profit revenue growth over the past 5 years?
Revenue growth over the last 5 years. I might owe somebody a little snack for this one, so I can go find somebody who understands utilities. 1.18, 1.26, 1.35, 1.36, 1.35.
Boom.
It is a check mark. It is a check mark. It has slowed down recently. I don't know why that is. but we'll have to figure. It's actually gone down, but we'll figure out that it's still a check mark, but something to understand about why it went down.
Profit growth over the last 5 years.
Let's go to the profit growth. 195, 200, 212, 226, 232. Chickadee check. We're 3 for 3 so far.
4. That's
4 for
4.
4.
Shares
4 for 4.
outstanding. Pillar number 5. Are the shares going down? Number of shares going down.
Okay, it's up slightly. 48, 49, 50, 50, 50, 50, 50, 50, 50, 50. It's up 2%. It's up 4% in the last 10 years. I'm not worried about that. I'm still going to give that one a check mark.
Okay. How about total current assets greater than total current liabilities?
I imagine this is going to be a very good number because it's a utility
Assets
company.
greater than liabilities.
I think it's going to be a very good number.
Great.
Total current assets, 828 million. Total current liabilities, 447 million. Boom. Check mark.
Wow.
Yep, they have $400 million extra.
Free cash flow growth, number 7.
Okay, so this is a good question because I don't know. I imagine this is going to be good. Ooh.
Tell me about it.
So free cash flow, 60 million, 50 million, 150, 180.
Boise, Idaho is one of the fastest
90.
growing areas in the U.S. Now, Paul, exploded. The companies are coming out of it. Rogue, famous restaurants.
Yeah, but guess what?
chains.
Everybody, like I understand it on this one because it's a utility company. The more people that move there, the more utility they're charging, et cetera.
Uh-huh.
So I do understand that thought process. But look at their free cash flow, guys. It is up, but it's weird. It's like all over the place. You got to understand why it went from.
Well,
and the other thing is
tripled and halved.
correct. And the other thing is a big chunk of their cash from operations goes to capital expenditures. I don't like that so much. I prefer at least half free cash flow from their cash from operations. So the average right here is 110, 260, 440, 530 divided by 5 is 106.
People are asking about banks, Paul. I know you try and stay away from banks because your understanding of it is
Yes.
not that.
Yes.
In
Guys,
depth.
you remember one thing. People would sit there and say, oh, I'm a stock expert. And say, I understand what I understand. I don't understand banks, utilities, and insurance companies. Right now, the average free cash flow they had in the last 5 years is 106 million times 20 is $2 billion, call it, right?
$2 billion. What are they actually worth? Dun, dun, dun. I need a drum roll.
4
on that.
billion.
Do you like that?
I do not like that. That's
Oh,
40.
way overvalued.
That's a
double
yes.
X.
That's an X.
Here,
It's
look
a
at
big
the
X.
I'll get the,
So it's not great. It's they're paying a nice dividend, which utility companies tend to do, 3.5% dividend.
Mhm.
Is it great? Is it not? I mean, this is a big ratio. They're selling for basically 40 times free cash flow. I don't know about that one. That's a big one. That's a big number. That's
Where
a
do you-
really big number.
What price do you like buying this stock? at?
I don't feel comfortable giving an answer. If I said half that, you'd be like, what? Come on, Paul. The problem is their free cash flow dropped a lot in the last year, and the average of 5 years is not good. It's an 80 right now. I'm probably looking at it. I'm looking at it to understand more, sub 60, which
60, Paul.
was how
Oh.
long ago? 2015. I know you sit there and say it's crazy, but this is a very crazy market.
Yes.
It's a very crazy market.
The housing market.
And to somebody who said, like the person who says Boise's growing fast,
Yes.
my comment is, that's great. In the last 4 years, though, their revenue has only gone up 100 million. It's gone up basically 8% over 4 years, which is roughly 2% a year. So if it's growing so fast, why is their revenue only going up 2% a year? By the way, that could be their growth overall. Population growth is only a very fast population growth is 1% or 2%.
Mm-hmm.
That's very fast. So it's growing, but it's a utility company still.
Yeah.
Heavily regulated. There are issues like that.
What about Embracer Group? Have you heard of this?
Embracer Group or Embraer Group?
I thought I wrote it. Don, did you see that comment? Embracer Group?
Embracer Group, EMBRAC, EMBRAC.
For those watching, really, we are tickled shitless by your support. I'm currently shitting my pants right now. It feels great with excitement.
Oh, this is a
with excitement. The fact that you're
a foreign company.
following and liking us. I've said this before on a
Yeah,
couple earlier podcasts.
I'm
like,
not even gonna look at this one.
when we got
Sorry, guys.
1,000 subscribers for Paul and I, it might have Paul and I and Don, our producer, might as well been 1 million. And so we appreciate the thumbs up and the following. It's incredible. All the questions,
All right,
it's great.
it's a foreign company, which
What's
I'm
wrong,
okay
Paul?
with, but it's 197 PE. I'm just gonna go ahead and say we're wasting our time now. Mobile games. It hasn't even been around a long time, guys. It's only been public for a year and a half. Not even. Yeah, not even a year and a half. It's been public for a year. I was sitting there and say there's better companies for us to go look at.
Yes.
Look at the history of it. I mean, we have very limited history. Yeah, massive growth, guys. But even their revenue is down from last year 20%.
Uh-huh.
So it's selling for 100, 200 times profit, pass.
People are asking about this O, which is
Give me a ticker symbol.
Realty Income Corp. I mean, is it O? People are just saying O.
Oh, it's a,
Is that a thing?
yep, there it is.
There we go. Sorry, everyone. We're on to it now. What is this?
Oh, 6,500 properties, single tenant, triple net lease retail properties. Retail, guys. So remember retail. Retail's suffering now. So you have to factor that in your analysis. And this is a REIT. REITs are a little misleading on their
Okay,
PE.
Listen, carefully analyze this because everyone is asking all about these REITs. Everyone wants to know what the hell this is going on.
So remember
and
on
so would
REITs,
I.
guys. So remember the recent scandal that Donald Trump has not paid any taxes in the last like 15 years?
Nicholas, we're wrestling at 10,000 subscribers. Paul and I will get fitted for our Everything Money singlets. We will hire an official, and I'll have to strap one or both hands to my chest or back to wrestle Paul due to the drastic weight difference. But that will be happening with the Everything Money singlet. And I assure you, I don't look good in a singlet, Paul.
We've gained a lot of subscribers since this whole thing started.
Keep going with
So,
O.
The good thing about a REIT,
What is your O face, Paul?
the PE is very misleading. Donald Trump recently got announced that he didn't pay any taxes. And people are like, oh, he's a shyster, all this stuff. He has real estate. Real estate has what's called depreciation. It's a non-cash expense. I won't get into the exact specifics of it, but it makes your earnings look a lot worse than it actually is. For a real estate investment trust, I'm going to go more towards the free cash flow, right? Their margin's huge, 26%. The PE, I'm not even going to comment on this 41. It's not really fair because they have depreciation in there. It's skewing the number down.
Okay.
But their margin looks pretty good.
Okay. Pillar number 3 is revenue growth over the last 5 years.
So look at their revenue growth. 1.2, 1.32, 1.485. So
Boom.
definite revenue growth. But you know what I want to look at? I want to look at their last couple quarters.
Okay.
Because, guys, I guarantee they've had a big hit to their revenue. I don't know if they bought a lot of properties, but if you look at their revenue from last year in June, 365, this year, June, 410. That's pretty good.
Ahmed said, I'm surprised you guys only have 1,200.
Get 100,000 before I get to $1 million.
We're going to get there.
Yep.
Keep
So
going, Paul.
their revenue growth is solid.
Profit growth of the last 5 years.
Okay, their profit growth also solid. 284, 315, 318, 360, 363, 436. Another check mark. Now, I talked about depreciation. Do they offer depreciation in here? So, on a real estate investment company, I might want to look at their EBITDA, which is okay. Now, they own this real estate. So, for an example, I'm going to sit there and skip ahead and say, this is an interesting one, guys. This is a very, very interesting one. Because this is real estate. This is a real estate play. As you can tell, there's a dividend that's pretty healthy here, 4.5%. Let's go. What's the next step?
Shares outstanding, pillar number 5.
Yes, shares outstanding.
Oh boy. What was that?
This means now is if you owned a share 10 years ago, I'll get 1/3 of the benefits you got before.
Uh-oh.
That is bad.
Bad stuff.
Now, again, no point here in and of itself is really bad. But I'd have to understand why are they issuing so many shares? Maybe they're buying a lot of property and that's what's driving, but their revenue growth hasn't tripled.
Someone said you can't look at shares outstanding with REITs. They finance the properties with equity. Every REIT has that.
Okay.
And
So
people
my next
agree.
comment was going to be this. My next comment was going to be this.
Go on.
Their revenue 10 years ago was 330 and now it's 1.5. So that's a valid point. However, then you can't give as much benefit to this revenue growth as before. And the other thing is, in 2015, their revenue is up about 50% since 2015. And their shares outstanding up less than 50%. So that's a good sign. But to say you don't finance something with equity. You fund it with equity. You don't finance something with equity. I get what you're saying. And this is part of the whole analysis you go later on. You still have to understand what their debt levels are. So what are their debt levels? Okay, guys, I'm going to go ahead and say, that's quarterly, right? Quarterly. Let's go to annual. What are you laughing about?
Oh, just when it's funny.
Okay. Their debt's a lot higher, 1.7 to 8.75. So it is 5 times higher also. Exactly. So it could be okay. It could be okay. You do want to understand why they issue that debt. You're sitting there saying REITs do that, issue more shares. You're absolutely, it could very well be the case. Again, this is why REITs are hard to look at times, because you have to understand that's why you have to look at the very specific financial data of every single company, every single REIT. What are they buying? The issue I have with this company is it's retail. Do we all think retail is going to do better or worse over the next 10 years?
Better?
I don't think so.
Oh,
Are people doing more or less buying on the internet?
more, way more.
And I think over 10 years, retail's going to have to change its approach.
Do you want to look at price to free cash flow?
Yes, let's go to price free cash flow.
Or
It doesn't really
no,
matter as much here.
Okay.
Well, let's look.
Okay.
Oh, okay. They have no capital expenditures here. It's probably it's all triple net leases. They don't have to put money in their properties. So it's 700, sorry. So it's pretty much everything goes to free cash flow. 700, 800, 875, 940, $1 billion. Solid, stable. We want it to be, the average here is, call it 850, 900. Let's call it 900 times 20 equals 18 billion. They're currently worth 20 billion.
Slightly overvalued?
Maybe. It all depends on, I mean, again, you guys will want me to give you this, hey, do this or don't do that.
I want you to give me that.
Investing is an art. It's not a science.
You've said this last time, which is funny because it looks very scientific.
It does, but it's still about analyzing the qualitative aspects of the business. Qualitatively, what does this REIT have problems? It's retail.
Mm-hmm.
That's a very bad qualitative aspect of the business, right? Do I like the fact that their free cash flow is growing? Yes, but we have to understand how much of that's from new acquisitions. If they're adding new acquisitions here, they're all doing worse. That number should be jumping up higher. So you have to go in there and understand what are they spending their cash on and how are they getting there? Here's the issue I have. Last year, they did $1 billion in free cash flow, right?
Mm-hmm.
$1 billion in free cash flow. They pay a 4.5% dividend on $20 billion times 4.5%. It's roughly $1 billion. So they're paying out all their free cash flow dividends. People sit there and say, oh, yeah, but that's what REITs have to do. Yeah, they do. They have to pay out 90% of their profit into the shareholders. But what happens if all of a sudden they lose a tenant because it's retail? They're not going to be able to support that dividend anymore. That is something to consider. If we're just looking for, yes, go buy the stock, I personally sit there and say, I'd rather avoid this. That's my personal opinion. It could do well, but I'd rather avoid it. Now, the good news is, for you guys, you're sitting there saying, well, Paul, I used to sell at $80 a share, now it's at $60. Yeah, very fair enough. Oh, sorry. Shoot. Fair enough. I used to do that, but I look at it saying, are there other options out there? Remember, investing is about opportunity cost. There are thousands and thousands of companies out there to invest in. If one doesn't, your job is to say no. Your job is to find a stock and say no, 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 and then finally find the one and say, yep, that's the one we're doing. The 8 pillars are a good way of weeding things out. To me, I look at all this going, with retail, it's not a screaming deal, so why would I do it? There's a thing called cap rate. Anybody who pays attention to the cap rate.
Mm-hmm.
Right now, it's selling for a 5% cap rate.
Too low.
I think to myself, for retail,
Mm-hmm.
I know guys in the area who do retail, and they're paying 8 to 9% cap rates for retail. Because they're like, hey, retail is tough. I look at this saying, I don't really like it. That's my opinion.
Marcos wants us to switch positions for one of the live streams, Paul.
What do you mean switch positions?
I go do that.
Oh, that'd be fun. We've talked about that before.
Thank you all for watching and for the thumbs up. Now, Paul, it looks like from the comments, our wonderful viewers, we could just sit here and do this for the rest of the day.
We could.
How are you feeling? How's the voice? They have more requests off the request line.
I appreciate that, but I think we have a podcast.
We
here
do have a
coming up.
live stream at 1 o'clock for a whole
Dynasty
entirely
Owner.
different company.
If you guys all love fantasy football, go to dynastyowner.com, go to our Dynasty Owner YouTube channel. It's a great game. I created it. It's awesome. Lock it down.
So we really appreciate it. I am making note. The comments are incredible. They're just absurdly incredible. Don is going to make notes. We will get to all of these. You guys are creating great content for us. And go ahead, Paul.
And don't forget the $100,000 giveaway.
Repeat
$5 million
that. Repeat
property.
that. Because we have a spike in
I will
viewers
give
right
you
now.
$100,000 if you bring me a deal off the market that is $5 million or more. You know somebody who has a big property,
your aunts,
apartments.
your dad, some grandpa's passing away.
I don't care who it is. You could be sitting at Panera Bread and here's some idiot behind you say, "Oh, I really wish I could sell my 150 unit property here in Boise, Idaho." Give me a call. Email don@crossroads-group.com. You put it again in the YouTube chat. And you will bring the deal. If I buy it, I give you a $100,000 sports car, or I'll just give you $100,000. I don't care either way. I'm going to give you something. I'm going to give you $100,000 in some way, shape, or form.
Thanks for all the new viewers. A lot of people are saying that YouTube brought you, sort of suggested us to you. So we're very happy. I hope you can see that unlike some other channels that I despise, that we are totally not full of bullshit. We avoid the clickbait. We bring you real analysis of stocks. That is not the bullshit. We're here to rock your world. And we appreciate all the loves out there.
Well, it's more than just stocks. Talk about real estate, talk about personal investing,
and businesses.
Finance, everything, business, everything.
Okay, Paul. What a wonderful live stream.
Yeah.
So long. I hope your voice isn't shot. We have more podcasting to do. Thank you all again. And we appreciate your support. Smash the like, subscribe. We'll see you next time.
Hit the like button. It makes me very happy.
Thanks, guys. Love
My
you.
self-worth is tied up in the like button.
Appreciate it. Love you.